topic that we've chosen today is debt mutual funds. A lot of people don't understand the concept of debt mutual funds. So we'll try to break down as to what consists in a debt mutual fund, how should one go about investing in a debt mutual fund, what are the criteria that one should watch out for before investing in a debt mutual fund. And to take forward this conversation, we are joined by Kshitij Mahajan, who's the Managing Partner and CEO at Complete Circle Wealth Solutions LLP. Joining us now, Kshitij, hi. Thank you so much for taking out the time and speaking with us. Before I go on, and ask you the details of debt mutual funds, very basic. If I were to explain to our viewer as to what a debt mutual fund is, what would how would you explain that to a viewer in a simple layman language?
Well, hi, good afternoon to you and to all the viewers. So I'll make it very simple. When you buy a deposit or a bank deposit or a private fixed deposit like LSE housing or any other corporate bond, you buy one single instrument. That's what you do. But when you buy a mutual fund, a debt mutual fund, basically you buy a pool of investment. In that pool, basically you just in that pool, basically you buy a lot of other deposits, a lot of other bonds underlying it, and that diversify your risk, and you look for preserving a wealth and maybe creating an extra delta vis-a-vis inflation through getting into a debt mutual fund. So it's a pool of investment of fixed income securities that includes corporate bonds, government securities, bank deposits, and through which you create a fund, and wherein you get a units and that get appreciated with a nominal rate of return, which is a little better than deposit, but yes, in line with what fixed income normally offers.
Got it. And with respect to the difference between a fixed deposit and a debt mutual fund, what is it like? I think liquidity is one aspect, but what are the other aspects as to how FD is different from debt mutual funds? Because both are fixed income sources, right?
Yes, so fixed deposit, let's say you do a fixed deposit of SBI Bank or HDFC Bank. So you have one instrument, and wherein RBI underlines and guaranteed 5 lakh per deposit, per bank, that's what it guarantees. But when it comes to private deposit, so let's say you buy Mahindra's corporate bond, or you buy Tata Sons corporate bond, or you buy, let's say, Reliance corporate bond, which are also deposit. So there are ways through which company raise money. One is you dilute your equity and raise money. Second is you take a debt from open market and raise money, and then you give that money for a given tenure, let's say 3 years, 5 years. So company has a project coming for 3 years, they raise money for 2.5 years so that they can give it back. So therein you are buying an individual paper when you are buying a deposit. Well, in mutual fund, so there is one risk. It's binary. You have that risk coming to that paper, whether that company will do well or not. When there is a fund, there's a pool of investment. The fund manager will buy 30, 40, 50, depending on the fund scenario. He'll buy different papers of different category, different ratings, and different institutions. So you diversify your risk vis-a-vis one single entity when it comes to fixed deposit. So that's a major, more broader difference in mutual fund and your fixed deposits.
Got it. When we talk about debt funds, and this from a retail investor point of view, who should ideally invest in a debt mutual fund? And just want to understand as to, of your entire portfolio of mutual funds, what percentage ideally would you suggest that should go as, as a part of debt mutual fund?
Well, they normally say 100 minus age is your equity allocation. Let's say if you're 20 years, 80% should be in equity and 80% should be in equity and 20% should be in fixed income. But it has to do with your risk appetite also. And very well said. I think asset allocation should be done before investing into mutual funds or any other asset class. You define that this much in equity, this much in fixed income, this much in gold. In fixed income part, markets have done well in 21, 22, 23. And suddenly we see that equity proportion has gone high vis-a-vis the defined asset allocation.
Correct.
So I think please understand that, fixed income is also equally important like equity, because it gives stability, it preserves your wealth to some extent, it gives stability, and at the same time, it gives you opportunity as and when markets are down, you can shift your gear from fixed income to equity also. So I believe it totally depends on one's risk appetite, asset allocation, what type of they are doing. But when they define, let's say if 25% will be in fixed income, then they should stand by that. So you can play it through a fixed income play only, wherein you can do a debt mutual fund, and the type of scheme which are available in India is from 1 day, you can invest for 1 day, 1 year, 3 year, 5 year, 10 year, depending on what time frame you want to invest. There are different funds which are available. Or you can play this through a balanced advantage fund or a multi-asset fund also,
Hmm.
where there's a clear-cut fixed income allocation which is there, depending on what type of balance funds or balanced advantage fund you're doing. So that's how one should go about allocating their allocation.
Understood. How much return can one realistically expect from these debt mutual funds, Kshitij?
It's difficult to say, but it totally depends on what cycle you're getting into.
Hmm.
So it's in hindsight, you say this type of return has generated. But when you invest in a fixed income mutual fund, the beauty of this is that there's a well-defined yield which has been given in the portfolio fact sheet, that right now the YTM is yield to maturity is, let's say, just for example, say 7% or 8%. And if you hold the paper, let's say the modified duration is 2.5 years, and if you hold the paper for that tenor, normally you get that type of return. So there is a mark to market element here in fixed income also, like in equity. So if rates, like in recent times, the currency has depreciated because of the tariff play, and we have seen 10 year again back to 6.45, 6.5. So you see that the yields have become little negative on fixed income. The returns have become little negative on the fixed income. So
Hmm.
there's a clear inverse relation between the yield and coupon and basically price of the bond. So
Hmm.
coupon and price of the bond is the inverse relation. So if 100 rupees is the price, then 8% is the yield. And you see suddenly there's a rate cut coming, then suddenly the next paper will be issued at 7%. That means the existing coupon will get adjusted to, the price will get adjusted to 101. So
Hmm.
your price of the bond will increase. So it has to do with price as well as the coupon. Both things will go in an inverse relation. If coupon decreases, your price increases. So
Hmm.
in the current scenario, if you ask me, you not only get a benefit of the YTM, whatever is in the portfolio, but you'll get the benefit of your mark to market element also, because when prices will cut further. So 50 paisa which got cut by last by RBI has not been actually reflected in the market, because there's been redemption from FIs. At the same time, there've been currency depreciation. What has happened? When one will start playing, you'll get a benefit of the capital appreciation also. So
Hmm.
so take for example any gilt fund. It has 10 years, let's say, modified duration, and if you have 1% which a rate cut which is coming your way, so normally you get 10% as a capital appreciation vis-a-vis the coupon which is in there. So it works really beautifully. But at the same time, the risk is what has happened in the last 2 months. Nobody's had thought of that, because of the tariff. There'll be money which has started moving out, and suddenly you see the reverse. The yields have gone up. Vis-a-vis, there is a rate cut, but the yields have gone up. So
Right.
there is a market element which is also very important. You just can't keep on banking on what is happening. But structurally, we have a low inflation. I'm very clear that, and I'm very hopeful that RBI will further rate cut the rates,
Hmm.
and we demand what we've been seen in GST, what have been seen in tax cuts. So those reforms will come, and you'll see that in current scenario, there are portfolio which can deliver 6.5, 7% returns,
Hmm.
depending on what type of YTMs they have.
That's an excellent answer, Kshitij, and that sums it up. So thank you for that. The other aspect is there are many categories also here, right? There's short term, there's gilt, there's also liquid funds. I mean, out of all of these, if an early investor is looking at these funds, how should he evaluate the difference between the three, and how should one go about it and go ahead and invest in one of these funds?
That's a very good question. I'll make it very simple. If you have money for a week or 10 days time or 15, 20 days time, let's say, which is a spare money, whether it's in your current account which is yielding you nothing, or in your saving bank account which is yielding you 2.5, 3%, it's better to put in a money market fund. When
Hmm.
you put money in money market fund, there is no exit load. You can withdraw money as and when you want. If you have fund which is more than 15, 20 days, up to 3 months, then you should look at liquid funds. If you have fund which is more than 3 months to 6 months, then you can look at ultra short term funds. That's a category of money manager funds. Anything which is more than 6 months, one should look at arbitrage funds or ultra short term fund, as well as money manager funds up to 1 year. 1 year plus, you should start looking at short term funds plus arbitrage funds. And if something is which is around 18 months to 2 years, 2.5 years, you can start looking at dynamic bond funds or corporate bond funds. That's what you should look at. If you have a time horizon which is more than 3 year plus, or if you are in that cycle where you're expecting a rate cut coming your way, once you look at gilt funds, because gilt funds they have a much longer modified duration. So the paper which they underlying which they buy is for much longer. So one should look at gilt fund, which is if you have a time horizon which is more than 3 years, or you are expecting rate cut cycle playing in coming times. So that's how you should structure it when you are looking at a fixed income portfolio.
Understood. Kshitij, if one were to go ahead and invest in these debt funds, would you recommend an SIP or would you recommend a lump sum investment?
I don't think that one should do SIP in debt funds. One should do a lump sum investment only. Having said that, if you are building your emergency portfolio and you can do this on a monthly basis, then a SIP is recommended. We always say one should have a 6 to 8 months salary as emergency portfolio, which is at your discretion if you are in a need of money. So let's say last 1 year capital markets hardly any return has been made in equities, but had it been there is a need of funds and you don't want to withdraw your equity portion, there is an emergency portfolio. So in emergency portfolio, one can look at doing a SIP unless until you have achieved that emergency portfolio. Once you have achieved that emergency portfolio, you can stop that SIP and then you can if whenever you have some lump sum money and you want to keep some powder dry to participate in equity, or let's say in 6 months time you want to buy a home, then you can do a lump sum. Don't do a SIP.
Okay, and generally, what are the risks involved? What should one ideally typically look at before? Because when you say you should go ahead and invest a lump sum amount, and you said that it also depends on what cycle you are picking up when it comes to these debt funds. What are the macro factors that one should look at, and what are the risks involved?
So yes, again a very good question because we always think that fixed deposit or debt mutual fund are safe assets. As I said, there are multiple risks involved. In fact, if you ask me, it's much wider and deeper in terms of its knowledge which one can impart from fixed income. So first risk is a credit risk, which is like today, you are talking about that yes, this company will pay me a coupon of 10 rupees after a year on 100 rupees, but tomorrow for some reason that has not been played out and the coupon has not been given, so that risk is there. Second is your interest cycle risk, which I spoke to you in last question, that you are expecting a rate cut and you are expecting a capital appreciation and you have parked the funds which is not in line with the maturity of the fund. Let's say the maturity of the fund is for 3 years, but you have parked it for 1 year, and after 1 year for some reason rate cut has not happened and rate increase has happened. So in that case, you are facing a problem wherein your coupon has gone up and price has reduced because the equation will remain the same. As I said, 100 rupees coupon, 8 rupees, 8 rupees coupon, 100 rupees price, total 108. If price will move up to 10 for some reason, this is just example, then your sorry, if coupon will move up to 10 for some reason, then price will go to 98. The equation will remain 108 for the new and the old one. So I'm saying in that case, you might have some negative scenario in the fund because if you're not holding it for long. But if you hold it for those 3 years, then there's no risk. And the third one is a liquidity risk tomorrow. For some reason, you have given money to a company, and the fund manager has given money to a company, and for some reason, they're not able to honor it. The business is not doing well, or they're having losses. We have seen in 2018, there's an ILFS crisis, CHFL crisis, CS Bank, many other crises have cropped up at that time. But I'm saying there are three broader risks which are there when it comes to fixed income. That's why a portfolio manager gets into 30, 40, 50 securities. He's not only buying one securities for you. And we always recommend when you are carving out your fixed income portfolio, also buy 2, 3 funds. So one is our individual portfolio have 30, 40 securities. Then you have 3 different funds. So your risk is diversified. So yes, it comes with its own risk parameters and factors.
All right, Kshitij, that was quite an insightful conversation. I'm sure if somebody wants to go ahead and buy a debt mutual fund right now, has complete information as to whether what he or she should do. So thank you so much for giving us those insights and, of course, taking out the time and speaking with us at NDTV Profit.